Well, welcome everybody. I think this is session number 14, if I'm counting correctly. For those of you that have joined us before, Chris Keefe and I have been hosting, mostly with Morgan Nighan, our partner as well, weekly and now bi-weekly sessions to talk about various issues that our clients and your businesses are facing out there as we sort of address and pivot and deal with this new normal. And so very happy to have a great panel who I'm going to introduce to you here in a few minutes. I just want to say a couple words here as a number of you are still filing in. I see there's a lot of folks still coming in. You know, over the last 3.5 to 4 months here, really since most of our states went into lockdown, we've had this amazing opportunity to have this dialogue together. And I was just reflecting on it. So, for example, we had a Navy SEAL on here, which some of you will remember. And by the way, all of our sessions have been recorded, so please feel free to go to our website, NixonPeabody.com, and check out some of the past ones. But we heard from Jason Redman, who described the feeling that all of us were having, like it felt like we got ambushed. You know, a lot of businesses were doing very well. I know for Chris, Morgan, and I, we had a lot of deals in the pipeline, and we just felt like we got ambushed. And when you get ambushed, you know, what we heard from the Navy SEAL Jason Redman is you got to move on that X that you're standing on. And I think a lot of people have done that. They've moved away from the ambush. And we heard from another Navy SEAL, Jason Kuhn, who was on twice, talking about how you can't control everything around you. You can only control yourself. And if you control how you react to what's presented in front of you, you can actually influence what you do. And we've had so many business leaders on over the last 4 months who have shared with us their stories of how they have influenced what's around them. And the thread through all of this is that there are trends that are out there that are now being accelerated. And a lot of businesses have had to adjust, pivot, you know, change the way that they do business. And you know, some are really struggling and some have been very successful. And it's very interesting for us to have this opportunity to reflect and think about all these trends that have been accelerated and what's sort of coming into the future. We're going to talk a little bit to Morgan about the PPP program, and obviously the government stimulus money has been a big part of this discussion. We're going to talk a little bit about maybe what's coming next. Underlying all of that is that a lot of businesses are facing liquidity issues. The PPP loans were part of the solution. For some, there were other programs and Main Street lending programs, state programs that some businesses have been able to avail themselves of and others have not. But liquidity really is at the heart of this. And so we thought that was an important enough topic that we asked Dan Head and Sheldon Hanau to join us today to help us, you know, share with us their thoughts and talk a little bit about liquidity and access to liquidity. So let me go ahead and introduce both Dan and Sheldon to you. So Dan Head, a great friend to Nixon Peabody, is the Senior Vice President in the Corporate Advisory and Banking Group of Brown Brothers, where he builds relationships with private owners. Dan began his career at Bank of Boston, where he covered energy, utility, project finance clients, and then moved to the technology group. After Bank of Boston, Dan joined Fleet Bank's technology division, where he's responsible for relationships with early stage, entrepreneur-owned and publicly traded technology firms. Dan works with a number of our clients, and he and his team at Brown Brothers really do an amazing job. It's great to have him here. And Sheldon Hanau is a partner and the Chief Strategy Officer of Proficio Capital Partners. In his role, Sheldon sets the strategic direction for the firm and leads the effort in implementing the goals for growth, value, and vision for his organization. He serves on the investment committee, where he splits his time on both public and private investment solutions. Prior to this life, he was a managing director at Wellington Management, where he directed industry research for the Americas and was a member of the Private Equity Oversight Committee, among others. Before joining Wellington, Sheldon spent 20 years at Credit Suisse as head of distribution and sales for U.S. equity research. Sheldon, it really is great to have you here, so thank you for joining us today. So before we get to Sheldon and Dan, we're very happy to have Morgan back. Morgan, you skipped our presentation a couple weeks ago, hopefully for vacation, although I think it was really for work. But we're still asking the same questions that we were asking 2 weeks ago and 4 weeks ago. I'm going to turn it over to Chris to jump right in.
Thanks, Phil. And thanks, everyone, for being here with us again today. I echo Phil's comments that we've had the benefit of some really terrific folks on our panels to help us triangulate around some of the trends we're seeing, but we've also had terrific input from our participants in our audience in terms of questions and suggestions for future programs. So keep all that stuff coming, and we really appreciate your input on what's been a really, I think, thought-provoking set of conversations we've had over the last 3 months. So Morgan, speaking of something we've been talking about for the last few months, folks are now sort of really hyper-focused in their PPP life cycle about the forgiveness process. So when are banks going to start taking applications for forgiveness, and what does that look like?
Thanks, Chris. Yeah, that's a great question. I want to make the point first that I think this is the first webinar that I've been on where we have no new guidance to discuss. So there's been no new guidance from the PPP program since, I think, June 25th. So it seems to have stabled out a little bit. And personally, I've seen the volume decrease a lot in kind of client questions. Most people have seemed to have figured out what they're doing, how they're proceeding. And as you said, they are in that place where they're coming up on forgiveness. So banks are accepting applications. It's up to the individual bank about their process and procedure. So I know Bank of America has a whole portal and a bunch of tools that it's set up, and other banks are doing the same. And you can apply as soon as either your covered period ends. So a lot of people have come up on the end of their 8-week period. So you could apply as soon as that ends. Or if you choose the longer 24-week period, you can apply as soon as you exhaust the funds. They've made clear that you can, if you choose 24 weeks, but you spend the money in 12 weeks, you can apply then. So I do encourage people to get their applications in. And I'll share with you that we've heard from some of the lending partners that we work with that for loans under $2 million, banks want to get those approved very quickly. And they're anticipating 7 to 10 days on the bank approval process for that, which is quite quick. Statutorily, they have 60 days to make that decision, but from their perspective, they just want to get those through. And get them forgiven. The bank really has an incentive to have these forgiven. I don't think they want a 1% loan sitting on their books. So from their perspective, they're trying to push this through. So once the bank makes their decision, the SBA then has an additional 90 days to review the lender's determination and approve it or flag it for review. So it's kind of hard to really give people a definitive answer about how long that's really going to take in practice. It could take quite some time, particularly if the loan file does get flagged. It's kind of taken out of the traditional process and it goes into its own audit review process, which we've not seen that happen yet. So kind of remains to be seen what that's going to look like. But that's kind of the process that you're going to see. And, the SBA still to this day has not made any kind of determination about eligibility for anybody. They've been relying on the borrower's determination of eligibility. So it's the forgiveness phase where you're going to start to see the SBA take a look and say, actually, you're not eligible for various reasons, so we're going to deny forgiveness. So that's where we expect those issues to kind of come up. So it's going to be an interesting couple of months.
So Morgan, I've got a two-part question for you. I want to ask you about companies that might be up for sale right now. But before I ask you about that, for business that's just sort of bumping along and, they spent all the money and they really are ready to ask for forgiveness, but they haven't put together the paperwork yet. And I think in part because the bank's not calling them and to push them and the SBA portal's not open yet. What's our advice to them? For example, should we be telling them to go ahead, put the application in and get it in as soon as possible? Or is there no rush? What's the conventional wisdom there?
Yeah, that's a good question. I mean, the big factor to consider is whether or not you need to make employment decisions. If you've spent the funds and now those funds are no longer there to pay your payroll costs, and you may have to do salary reductions or layoffs, you might want to get that in early before that you have to make those decisions. Because they make clear that if you've had to do cuts, if you had to do cuts on day one and you spend the funds on 10 weeks, you have to carry those through the 24 weeks. But if you apply and then make cuts, that's not going to be part of your application. So that's a big factor you have to consider is, if you get your application in, the only data that's part of the application is the day you apply. So any layoffs or salary reductions that happen after your application aren't going to be part of that. So that's going to be, a benefit to folks to apply early if you think you might have to lay people off.
I see. Okay. And then, Chris and I are seeing a lot more deal flow, right? We're starting to see the deals pick up again. And we have a number of situations where the target here, the seller, took PPP money, right? And sometimes, $750,000, $1 million, $1.5 million. And we're hearing that there's some concern about, if we close the deal, so there's effectively a change of control, right? Because they've sold, that they may not then no longer be eligible for forgiveness, especially where the buyer's a private equity fund or a venture fund or something like that. So what advice can you give to those sellers that are facing that situation?
Yeah, that's a really good question. This is a really interesting kind of tricky issue, and I've been lucky enough to advise on a couple of different deals, so I've seen a lot of kind of aspects of this. So it's really problematic during this time frame right now because applicants, they've got their money, a lot of them have spent some or all of it, but they haven't yet figured out if they're going to have it forgiven or how much. So that is really hard to kind of control around that unknown. So if the loan's been forgiven, there's really very minimal risk. The loan itself is still subject to being audited, so you would still need to diligence it and make sure that the application was proper and that the entity was actually eligible. But if it's already been forgiven, then there's a decision been made about that, so you can rely on that. It's really when you're in the situation where they haven't yet applied for forgiveness, and as we discussed with that process I laid out before, the timing is just really not clear about how long that's going to take. So, and the other issue we're seeing is that for other SBA loans, not PPP, but for EIDL loans or traditional SBA loans, the SBA it says it has to approve any change in ownership in the applicant. That's not been made express for the PPP program, but lots of banks who have worked with the SBA are insisting on that for PPP. They're saying if you want to have a change in control, we need the SBA to approve that. And we have just no idea about what that process entails, how long it might take. There's no formal guidance about that, and the SBA is quite, busy right now administering the program. So it's, easy to think that it might take a while for that kind of approval to happen. So that's kind of an issue that is giving people some heartburn. And then the other thing we've seen is that you have to really take a look at the loan documents because a lot of banks have covenants in the loan documents that make a change in ownership an event of default of the loan. Which is not a requirement of PPP. That's an individual bank covenant that some banks have put in those loan documents. So that's been an issue that we've had to work through with a couple different lenders in some deals. So because of all this uncertainty, so some of the ways some of our clients have gone is just to make payoff of the loan a condition of the transaction, just to get rid of that risk. They either have to get it forgiven or pay it off, and that's the only way that the closing will happen. And that's kind of the way that you can minimize risk. Because there is just a lot of uncertainties right now about, how this is going to happen in this interim where companies don't yet have that forgiveness decision.
And then, Morgan, if you're satisfied from the diligence front, that you're not prepared to, as a seller, pay out that obligation, or as a buyer necessarily insist on that from your seller, then you've got sort of the quandary of what do you do with it in terms of allocation of risk within the purchase agreement, and the forgiveness period might not line up with the purchase price adjustment. And as a buyer, you may not want to put it to an indemnity. So you end up treating it sort of more like a tax position and a tax refund. We've got some feedback from people in the industry that there might be some insurance products around the transactional risk category that might help protect against that sort of an outgrowth of the tax rep or tax position policies that are out there. So there's a lot to consider, to Phil's point, as deals are coming back online in the midst of these forgiveness conversations.
Yeah, that's a good point. I mean, with anything with this program, you cannot eliminate risk because you're dealing with a program that's constantly changing, but there are things you can do to kind of minimize it and structure it so you're, making sure that you put yourself in the best position possible to not have to deal with the kind of audits that come down the road from this.
That being said, with sort of the bit of flagging demand we saw at the end of the second round of PPP funding, and we'll talk about Main Street Lending Program here, I know, in a minute. What do you think the prospects are of additional funding going into the program?
Yeah, that's a good question. Well, there definitely will likely be another phase. So when the PPP program application period ended, there was still $130 billion left in it that had not yet been allocated. So I know Marco Rubio and Treasury Secretary Mnuchin have stated that they do want to do another PPP round with at least with those funds and potentially with other funds. Congress is negotiating the phase 5 stimulus package right now. It's still really early on in the negotiations. There's a lot of moving parts, a lot of people advocating for various programs, so it's too early to tell what's going to happen with it. But I do think because this is already, the program rules are written, the process has been set up, it would make sense for them to continue to use PPP to get funds out there. But I do think you're going to see some significant restrictions on eligibility. There's a lot of criticism about certain companies that had access to PPP funds, and there were just no eligibility restrictions at the outset because of the kind of emergency nature of things. But I think that they're going to try to put a lot of restrictions on there to really kind of target it to the companies that are really struggling. So that could look, you might have to show an actual revenue decline as a result of COVID-19. That was not a requirement for PPP. They could put some kinds of requirements in there that would kind of target it to the most needy companies. So I expect that we'll see that.
Well, Morgan, thank you so much. As always, we're going to invite you to stay on. And as we've done in the past, if anybody has questions, click on that question button or the chat button and type in your questions for Morgan, and she'd be happy to answer them for you. So thank you, Morgan. That's very insightful. I hope in 2 weeks we won't be asking you the exact same questions again, or maybe if we do, we'll have some more guidance, but thank you.
I'll be here.
Sheldon, we're going to bring you into the conversation, and it's great to have you on here. I wanted to, Sheldon, to ask you maybe to start by tell us a little bit about Proficio and what Proficio Capital Partners does.
Sure. Thanks, Phil. Can you hear me?
Yes.
Proficio Capital is a family office. We manage about over $2 billion of assets. And the history of Proficio is two partners that started for their own families. And the goal was to really manage their money in a different way, focused on asset allocation, focused on taxes, and focused on wealth preservation. And I joined about a year and a half ago working with both these gentlemen, Matthew Ross and Bob Haber. And what we do is we manage money for our families in the same way that we manage money for other families. And so what we say is we eat our own cooking, which I think is a really unique strategy because we invest alongside all our other families that are part of our company. And the other thing is we're all from the institutional side of the business. So we don't come from the retail part of the business from wealth management firms. Rather, we come from Fidelity, Wellington, Credit Suisse, Goldman Sachs, on the institutional side. So we bring a bit of an institutional framework. And I'd say the key tenets are asset allocation and tax management for wealth preservation.
Thank you. Sheldon, where you sit and where you're, from your family's perspective, what's your outlook for the economy right now? And generally speaking, how are you positioning yourself?
Such an easy question, Chris. I mean, that's too much of a layup.
Look into your crystal ball.
Yeah. You know, I like the way Phil started with ambush because, look, the economy's been ambushed. And it's a very unique ambush that none of us have ever seen, no matter how many years we've been in the business. So here's where we are right now. Our view is that a couple of comments. I'll start with this. We don't think there's a V recovery in the economy, specifically saying the economy versus the market. We want to be careful to distinguish between those two. And the reason is because right now, literally, GDP could be down 15 to 50% over the next 6 months, literally. And that's the range we're talking about in terms of the potential. With unemployment at 11%, that's the challenge. Now, the V could be a V to a vaccine, and a vaccine would obviously take all bets off the table. But the data that we're tracking right now, Chris, that makes us a little concerned about the economy is we track the Dallas Fed, for example, has this mobility data that they track. This mobility data tracks telephone usage, it tracks transportation, and that was definitely improving from the lows, and now it's starting to stagnate. You probably have seen that with airline activity as well. The other thing is initial jobless claims, even today, they spiked higher than we thought. So they were 1.4 million of initial jobless claims. And now we have continuous claims at 16 million. So when you think about unemployment at 11%, that's not a recession, that's a depression. Now, with a vaccine, does that come back? Yes. The reason I'm separating that, Chris, from the market is because the market in some ways has been rational. I'm not going to say in valuation, but the work from home stocks, the stocks that are exposed to the benefits of this are working. And other sectors, lodging, cruise lines, transportation, those have not worked. And so there has been a logic in the market. But what's helped the market is the Fed. And, you know, there's an expression, you've all heard it, don't fight the Fed. It's true. And you just can't fight the Fed. And just to give you an example, when we had the great financial crisis, it took them 18 months to print money. Now it took them a month. And as Morgan was talking about, all these programs, you never have seen the speed in which both monetary policy and fiscal policy have acted. So you can't fight that. So are we nervous about the valuations of the market? Yeah, I'm happy, Chris, to expand on that. But there has been logic in the market in where it's been going. So I'll pause there if that's for a follow-up question.
Yeah, just one quick follow-up, Sheldon. I think, how much in your view, certainly the PPP and a number of the other actions the Fed has taken and the Treasury Department has taken, the Congress has taken with respect to, extension of unemployment benefits and the like has softened the impact, but it's also in some respects, I think, probably masked the impact of the damage to the underlying economy, right? And at some point, those tools are either more difficult, either from an economic or political perspective, to keep using, or just stop having an impact. I mean, when do you think we start to see the real pain?
So it's a good. I agree with you. You push hard. You push too hard, you're pushing on a string, as they say, in terms of benefit. I would say we're not there yet, but I do think, or maybe answering this in a different way, stepping back and thinking about the implications of everything that's happened, and not just the immediate implications, but the long-term implications. And I think that's where we have a pretty strong view about, for example, the dollar, pretty strong view about where rates are going, and a pretty strong view about gold. Because we do think that the implications of these on a macroeconomic level are pretty high. So, for example, with all this printing of money and all this fiscal stimulus, you base our view is the dollar is going to continue to weaken. And the reason simply is because you're basically debasing the currency by just printing more and more money. And that's not going away. And so a weaker dollar and a weaker currency, our view is a way to think about holistically where you want your assets. And we would rather have our assets actually in gold. And we have a big position in gold, frankly, because our view is that that's a more stable currency. I'm happy to get into that, and we can talk much more in depth about that. But I do think that is one implication in terms of the market. The other implication in terms of how much more can this help is the reality is even with a vaccine, I think there's changes in the economy that are permanent. I think we've all recognized that. And so that part of it, what percent of the unemployment rate that we think about is permanent, not temporary. And that view is probably more than 5 to 7% right now, which is a very big unemployment number when you think about it over history.
So Sheldon, we're going to follow up with you on that gold question. Chris or one of us is going to ask you whether I need to hold on to my Krugerrands. So we'll come back to that. But I want to first ask you about the sort of classic 60-40 approach, to investing in your portfolio. And, have you guys moved off that approach? Are you looking at viewing this differently? Talk to us about that.
Yeah, it's a good question, Phil. It's an important one because 60-40, which means 60% equities and 40% fixed income and bonds, has been a very good way to allocate assets. In fact, we look at we look at a lot of metrics, but it's up over 130% over the last 5 years if we would have done it in a 60-40 ratio. And some of the metrics you look at would indicate that this has been probably the best way to allocate assets on a risk-adjusted basis, which is how we look at it, even more than equities over the last 5 to 7 years. Here's the challenge right now. Right now, the 10-year is paying you under 60 basis points. So 40% of your portfolio is not earning more than 40 basis points. That's pre-tax, and that's pre-fees for whatever fees you're paying. Now, you could look at Germany, you can look at Japan, and you could say to yourself, well, they went to negative rates, so there's more room for the yields to go down. But again, when we say don't fight the Fed has already said they don't want to move to negative rates, and you got to believe them at face value. So our fear is that when you look back and you look at how fixed income has done phenomenally well, that 40% of the 60-40, our fear is that's not going to be the same going forward. And you're not getting paid now to own fixed income. You can't generate any income from it. So what we have thought about at Proficio, and we're doing it right now, is looking for another way to get exposure to fixed income through uncorrelated assets, but truly uncorrelated assets that aren't tied or connected in regression analysis to equities and fixed income. And the goal is to be a ballast in the portfolio, replacing fixed income with these uncorrelated assets. And we have a portfolio that we manage for our families of these in order to create that ballast to equities, to give you that stability and not have to have exposure to this low return or zero return fixed income market.
So Sheldon, you talked just before about sort of the reasons that you're looking at precious metals and gold significantly in the portfolio for your families now. Is that sort of a bridge strategy to deal with the debasing of the dollar that's going on now, or do you feel like that's going to be a longer term strategy for the next 3, 5, however many years?
Yeah, Chris. So I will start by saying before I started Proficio, I never owned any gold. So it was hard for me to get my arms around gold, to be really honest. So if you don't mind, I'll dumb it down for myself because gold is hard for people to get their arms around. But and I'll answer your question directly. But think of gold as a currency because it is a currency. It's actually been a currency for 3,000 years, longer than any other. And it doesn't have any liabilities to any country in the world. It's tradable to any country in the world. And there's very limited supply coming. In fact, now there's hardly any supply coming into the market. So that's what gold is as a currency. And so you could have your money in a currency like that, or you can have money in the dollar, which we know there's a lot more dollars coming on. And in fact, you used to be bribed to own dollars because you get a T-bill rate. You get some interest by owning dollars. Now you're not getting that either. So that was the argument for not owning gold, that you can't get a return. So to answer your question more specifically, as the dollar weakens, we do believe that gold is a good asset to own. And gold is a good asset to own maybe for multi-years. Now, we have a very high position in our portfolio. And it's 20%, which has worked really well. I can talk more about that. Will we have that 2 years from now? Probably not that exposure. But again, going back to this concept of a balance, we definitely would like to have 8% of our portfolios in gold for many of the reasons coming forward. The other thing we really haven't talked about with the debasement of the currency is inflation. And, I've been in the business a long time. None of us have really experienced the inflation of the 80s. In the 80s, inflation got to 16%, and by no means am I ever advocating we're going to get there. But we haven't seen inflation. Now we're slowly starting to see food inflation and other inflation. And inflation is another reason you may want to think about having exposure to gold.
Well, Sheldon, anyone who knows me knows that I grew up in Southern Africa, and so I'm quite partial to Krugerrands. And every time I buy any Krugerrands, every money manager in my life yells at me, "Don't buy gold. That's a bad investment," And so I'm going to take this recording of you talking about gold, and I'm going to send it to every money manager in my life, including Dan, who heard it live, and everybody at Brown Brothers. But yeah. We'll give Dan a chance to talk about gold a little bit, but I've been vindicated, so Sheldon, thank you for that.
You're welcome.
Sheldon, talk a little bit about the topics of discussion from your families. What are the families asking you about now at this time?
Yeah, so the biggest topics are two. One is taxes. I'd say that's the biggest concern and the focus for everybody right now. I'm not making a political statement, but I think full stop, taxes are going up. And it goes back to, Chris, your comment or question about what are the secondary implications, the second derivatives of this, is that we need to raise taxes, full stop, in order to pay for now it's going to probably be, after the next fiscal bill, another $9 trillion of funding into this economy, into this stimulus. So in terms of taxes, the questions our families we're working with are next generation planning. And if you haven't done your next generation planning now in terms of setting up GSTs, generation skipping trusts, now is a very important time to really start moving ahead on that and moving that over, because those laws are going to change when it comes to trust and estates and the rules around that. Insurance, different types of insurance in terms of having upon death insurance to manage all the tax liabilities that are coming up. So I'd say all those factors around tax is a big deal, and that's what families are spending a lot of time with right now. And then the second is thinking about with the economy and positioning themselves with both their family and their businesses, is how are they managing their risk of their business versus their risk of their assets, and making sure that they don't have overexposure between a business risk that they have with their company and their investment risk. So we're spending time managing holistically families' assets to make sure that we're managing that risk so that we reduce some exposure. They have too high exposure in their company risk, the economy in their portfolio.
So Sheldon, we're going to turn to Dan here in a minute, but before we do, you mentioned earlier that you're really looking at replacing some of the fixed income products that you've traditionally held in the portfolio with uncorrelated assets. Talk to us about some of sort of the factors and hurdles you look at when you're trying to pick assets to both generally speaking, but also specifically to replace those fixed income products.
Yeah. And I don't want to get too technical, but I'll mention how we think about it. Our goal is threefold. One is we can run a regression or comparative analysis to see, does it correlate to equities or not, and to fixed income. And the goal is that it should not correlate. So it should zig when the market zags. That's one goal of the uncorrelated. So that's one factor that we look at to make sure that it works. The second is we try to replace income, which is really hard these days. And we're not going to replace income at a 7% level, but we want to have income above inflation, and we want to have income above really some certain hurdles depending on the portfolio that we're building. But so we're looking for income out of this. And then the third is testing these assets, and this is a combination of assets, the portfolio, for how they've handled in the past dislocations in the market. Because you can have a lot of time when uncorrelated acts as an uncorrelated until all of a sudden the market turns hard, and then they don't act uncorrelated. And you really want to be comfortable in those moments in time that they truly do that. So I'd say those are the three factors that we definitely build our portfolios around to help manage what we're trying to accomplish through these uncorrelated.
One more question, Sheldon, for you before we go to Dan. So interested to know what your thoughts are and your observations on liquidity in the marketplace right now. What are you seeing?
Yeah, I mean, I've lived through a bunch of market corrections, and I would say there's very good liquidity in the market. And I have to give credit to both the markets and the Fed for creating that liquidity. So it's been a very rational market in the sense that you haven't had those dislocations where bid-ask spreads have really fallen wide and did not really correlate to logic. And I think it's simply because there was so much capital being thrown at the market that it allowed the market and liquidity to be good. Now, I don't want to create fear, but just because we did that in the first part of this correction, it doesn't mean we'll see that in the future. Like, in other words, there is some concern that there could be some liquidity fears going forward if we see another hit to the market, because, like as Chris said, we may not see the same amount of capital flowing into the market as we've had in the past. But for now, the liquidity has been very stable, very rational market. Bid-ask spreads, you can get trading activity done in the rational way.
Sheldon, thank you very much. Appreciate all that. Dan, we're going to turn to you, and that's actually a perfect segue. I mean, from your perspective, how do you view the supports that the Fed has put into place and the actions that it's taken? How's that impacted strategic investors?
I do want to get back to Phil on gold at some point, Chris. So we did write a piece on that, so we'll circle back to that. But as far as the Fed goes, it was extraordinary what they did in March. It created a market where there was an amazing amount of corporate debt issuance. I think counting through the end of May, there was $1 trillion of investment grade debt that was issued that was new to the market. And that was because of the Fed put. And the Fed put even extended to high yield bonds. Had that happened in 2008 or 9, it might have been a different story back then. So we think the Fed backstop, dealt directly with the uncertainty, calmed investors, let issuers, think through, okay, I have an opportunity to load up on liquidity in a way that I probably wouldn't have had in the past. So they issued enormous amounts of debt. And when we get into discussion of M&A and the middle market, I think strategics are going to be a huge factor now because they are so liquid. Some of them cannot innovate as well as they can through making acquisitions. So it was outstanding what the Fed did and positioned the market for stability. But like Sheldon, I'm concerned that, as stimulus wears off, as the PPP loan program wears out, what's next and what, there's going to be more pain, I think, for certain businesses and certain folks down the road. I think the election year is going to maybe push that pain off because the politicians are going to cooperate to try to support the markets. But it's inevitable. We just cannot. Businesses, we're up to about $11 trillion in corporate debt in our country right now, all-time highs. You take that plus all of the the Fed intervention in the market. It's just we're extraordinary levels of debt relative to GDP and income.
So Dan, I'm going to ask you about the gold. Am I selling my Krugerrands to Sheldon, or am I buying more? What am I doing here, Dan?
Well, my colleague Scott Clemens, who's our chief investment officer, wrote a piece on gold and commodities. What's interesting about
Dan, I think we've lost you here. Chris, he was just about to tell me if I'm buying more or selling.
I know, the irony is delicious.
I can't answer that question, am I, Phil? I'm not allowed to answer that question.
Well, if you're a buyer, Sheldon, I'm definitely interested in talking to you. But, all right, Dan, it looks like you're back. You were just about to tell me the answer.
Yeah. So we hold securities that generate cash flows so we can calculate a discounted cash flow. Commodities do not. That said, we do lend money to commodity traders. And in the U.S., we are one of the largest commodity trading lending banks. We do not lend money against precious metals. So we're not in that part of the market. So we would take the other side of that trade with Sheldon. We would not, at the moment, be buying commodities or Krugerrands. We are investors. We have about $39 billion in assets for our private clients. We have another $50 billion for our institutional investors. We are primarily a concentrated equity investor in our own funds and in third-party funds. And in terms of the alignment that Sheldon discussed earlier, in order for Brown Brothers to work with a third-party manager, they have to have skin in the game. So they have to have a significant amount of their own personal wealth invested in their strategy. So we think that our clients over time are going to get superior returns and beat inflation through investing in equities in a concentrated fashion and across different equity asset classes.
So Dan, a lot of us have seen headlines recently on increases in loan loss reserves by major U.S. banks. And, I think, Phil and I, who do a lot of M&A work, were sort of shocked in a pleasant way. Hopefully Dan can still hear us when his bandwidth is low here. But we're shocked in a pleasant way about how normally lenders continued to behave in the earliest part of the crisis. I think we've noticed lately in the market that maybe standards seem to be tightening a little bit, processes seem to be taking a little longer, and obviously we've seen as I said, the headlines about the loss reserves. How do you think that impacts the M&A market over Q3, Q4?
Chris, I'm sorry, you broke up a little bit, and I know that was
no
a good
problem.
question.
Was just asking, sort of given what you're seeing in the market in terms of loan loss reserves, but also, we're seeing as M&A practitioners a little bit of tightening for credit standards, a little bit of tightening of process and that sort of thing. How do you think that impacts M&A activity in Q3, Q4?
Okay, so let me just try to take that. So yeah, there's been major loan loss reserve recognition at most U.S. banks, and it's been all over the papers. The difference between now and 2008 is the banks' reserves were in much better shape. The banks were taking much less risk. Most of the risk for leveraged buyouts, a lot of private equity-backed transactions, as you know, shifted to the direct lender market away from commercial banks. So despite those big, nasty negative numbers, commercial banks are still lending. They got a big boost from the PPP loan program. They're going to make significant fees from that. The question, so I'll talk about the markets in two pieces. On the commercial banking side is what are you going to do next? And in talking with other commercial lenders, they will tell you we're open for business. However, we're mostly working on waivers and amendments because our borrowers, some of our borrowers are violating covenants. And we don't have that much new activity to look at. If you then shift to direct lenders who have developed close relationships with private equity funds, they're seeing more activity. And they are, we moved out of the high uncertainty of March and April to now a greater level of deal flow, but the terms have changed. As you know, the terms have tightened. The total amount of debt that a direct lender or a bank would put on a private equity-owned company is less, maybe a turn to a turn and a half less in terms of debt to EBITDA. The interest rates spiked about 200 to 300 basis points wider in March and April. Now they've come in about another 100 basis points. So just to give you an example, if a business needed to borrow, say it was a $100 million deal, and they wanted to borrow $50 million today, that's a 50-50 deal. They'd be looking for a 50% equity contribution from the private equity firm. That's higher than they've done in the past. They could borrow, in April at maybe 9 to 10%. And today that's moved down to 7 or 8%. We think that's probably going to move lower as we get through the second wave of the virus. As we can test more, as we get closer to a vaccine, certainty is going to arise among essential businesses, and particularly those that want to exit or take some chips off the table. They're going to have a better lending market than they will right at the moment. But right at the moment isn't so bad, isn't as bad as I would have thought it was, say, in April.
So Dan, Sheldon reminded us that there is a big election coming up in November, and there's a strong possibility that our taxes are going to have to go up. Interested to hear your view. Does it matter whether a Republican or a Democrat is in the White House? Either way, are we looking at higher taxes? How are you guys thinking about this?
Well, we're not particularly good at predicting elections. However, we think that there is a likelihood there's going to be a tax increase and an increase in capital gains. So then that might make a seller might think, gee, I ought to get my deal done before that happens, because you have an election, then you have an inauguration, then you have the first 90 days. So if there are folks thinking about a transaction and that's a big concern of theirs, then they really better start preparing now. I don't think they have to, do their deal before the election. That would be, way too much of a rush given how long it takes to get a deal done nowadays. But, certainly if they could get it in within the first 90 days of next year, that might be a good idea and deal with some of the tax uncertainty.
Dan, you mentioned just a moment ago sort of the role of direct lenders, and we see sort of significant activity in their role as sort of primary source for senior secured financing of private equity deals. You mentioned that a number of those lenders have developed pretty close relationships with a lot of very active funds. To this point, those structures have been very sort of issuer friendly, covenant light or covenant not at all, and very generous in terms of balloons or minimal amortization on the loans. You talked about sort of the variation in pricing, but do you see some structural changes coming in the market in the near to medium term?
Yes. So you probably would agree. It's obviously easier to make a loan to a private equity fund portfolio company today that's making a tuck-in acquisition. Much easier to raise capital there. A little bit harder for a new platform acquisition where most of the proceeds is going to an owner that's going to exit the business. That's a tougher deal today because on a lot of levels, it's the risk, but it's also even doing the diligence, getting in front of people, getting on planes, working with the lawyers, working with the accountants. We can do a lot remotely, but at the end of the day, you've got to meet the people that you're investing in or you're lending to and get comfortable with them. So that, I think, slows the process a bit. But I think with respect to structure, you probably are also seeing restrictions on distributions, restrictions on, flexibility in prepayment. Most of the direct lending funds are structured so they're structured like bond funds, so they're not looking for amortization where the banks are. So I think that still makes them an attractive product. But I think they're gonna, because of, they have challenges in their portfolio companies. And earlier, Sheldon mentioned the areas which isn't typically, strong for investment right now: hospitality, retail, restaurants, and so forth. So somebody somewhere has exposure in those sectors, and they're taking charge-offs and they're having to deal with problems. So those folks, could be out of the market, where others who have no exposure to those sectors will be more active.
Sheldon, maybe we'll go back to you for one question. We'll make this a jump ball. Dan can weigh in when he comes back. In what you're seeing in the market, have you seen different tiers of the market being impacted in different ways in terms of valuation and pricing of assets? So has this shift in the market hit smaller, middle-sized companies, large companies differently?
Yeah, you have 5 companies now with over $1 trillion of market. And if you look at the NASDAQ, 20%, the makeup of the NASDAQ is basically the FANG stocks, as they call it, which I'm sure you've heard of. And if you look at the performance of stocks, large cap growth in specific has meaningfully outperformed small and mid cap in a significant way. And growth stocks have meaningfully outperformed value stocks. So it goes back a little bit, Chris, to, I guess your question to me, there's been some rationality to the market in the respect that Amazon has gone up and Google and Facebook have gone up. However, the spread now between growth and values is as wide as it's ever been. So in the public world, small and mid-sized companies are definitely not getting the benefit in the markets over the last 3 months as large cap. And in fact, in the S&P, I think the stat today, don't quote me exactly on it, is the average stock in the S&P is still down, I think it's about 9%. Actually, maybe you have 7 to 6% right now, with the S&P being actually flat up for the year.
Dan, I want to go back to you. Hopefully you can hear us okay, Dan, because Sheldon used the I word inflation. And it's not the first time we heard it. In fact, 2 weeks ago, we had a guest on explaining to us their prediction that inflation is going to go up. And I see we've lost Dan here, Chris.
Sorry, Phil, you're broken up a bit.
Yeah, Dan. Yeah, I think we're having bandwidth issues with you there. Give him one more second, but I think we've lost him. Well, Chris, that's unfortunate.
Sorry.
Yeah, Dan, are you back?
There we go.
He's back.
Yeah. Dan, I want to hear your view about
inflation.
Yeah, what's your view on inflation? We're hearing it. Sheldon talked about it. We heard it a couple of weeks ago as well. What's your prediction on inflation?
Well, on inflation, I mean, for us as investors, it's still a concern long term. Obviously, not seeing much right now on the horizon. Very concerned about how much debt the government is borrowing and how we're going to serve that debt. Yet the cost of that debt is close to free from a real interest rate perspective. 10-year treasuries are 0.6%, 0.7%. It's just so unusual. But we tell all of our clients that we don't think inflation has been repealed long term. So part of how we invest and protect capital is from an equity perspective through the equity side of their portfolio. We think that's probably the best hedge long term against inflation.
So question, maybe a jump ball question for both of you, Dan and Sheldon. We've been talking about inflation. We've been talking about all the, we're talking about the potential for increase in taxes, given the spending and the other actions that have been taken with respect to COVID. Is this all going to be a perfect storm, sort of 3 to 5 years down the road, when we also run into the can that was kicked a number of years ago in terms of entitlement reform and Social Security and Medicare?
Dan,
Why don't you start? That broke up a little bit for me.
Sure. So, I mean, look, I think that, frankly, we've been kicking the can down the road for a while now. When you look at our current deficits pre-COVID. But the market's allowed that, and the market has allowed that for a long time now, printing more money and in creating rates that are, as Dan was actually saying, unsustainably low. So there is clearly that exogenous risk, is the way I think about it, that's out there. It's not going to be immediate. It's not going to hit us immediately. But one thing interesting thinking about inflation is, if you think about it, the Fed wants inflation right now. And again, I'm not saying we're getting crazy inflation, but with our debt burden, having a little inflation is going to be really good for you in some ways. And so, again, I commented earlier about not fighting the Fed. It also plays out as well when you think about inflation. Now, again, it's hard. We've been in a deflationary environment. Technology drives inflation. So getting any inflation is not necessarily going to happen quickly, but we do believe it'll happen. But to your point, going back to the kicking down the road, it's a concern we have for sure in terms of who's going to pay for all this. And it goes back to taxes, and it goes back to a lot of other factors of currency that are top of mind for us.
I'm sorry, Chris, I can't hear you guys that well at all, and I just reconnected my audio. So if you wanted to restate the question or put it in chat, I could respond.
Sure. We were just chatting about how is the pressure to increase taxes going to be exacerbated in the medium term by our failure previously the last couple of times around to enact meaningful entitlement reform with respect to Social Security and Medicare and the like.
Sorry, I can't, Chris, I cannot hear a word you're saying. I'm sorry.
No worries.
This call went well. But...
Yeah, there you go. So Phil, I think you were at a question about what sectors are going to be particularly active from an M&A perspective.
Yeah, I mean, that's a great thing to think about and talk about a little bit. It is great. I must say, it's great it's a relief, I think, Chris, for us to see deals coming back. I wouldn't mind just putting in my 2 cents if I could, in areas like life sciences, for example, or anything digital. We are seeing deals come back, particularly in those areas, and they're premium deals. The prices are very high, which is great, if you are a seller in that market, and a lot of buyers are sort of bullish. There are other industries and other areas, of course, that are doing well, and I think, as both Dan and Sheldon mentioned, there are some industries, retail, hospitality, tourism, etc. I mean, the poor restaurants and hotels have just gotten hammered. And so unfortunately, and especially retail, we're seeing a lot of distress deals in that area. You know, if you read the paper, you can see which companies are filing bankruptcy, and we're involved in, you know, in some of those bankruptcies as well. And I think in a lot of those cases, those companies are going to emerge from bankruptcy. You're going to have a sort of traditional 363 sale, and they're going to come out, and employees are still going to be employed, and you know, there are some creditors that are going to take losses and so forth. But I'm not seeing a lot of those companies being liquidated. We're seeing a lot of them being acquired. You know, but Sheldon, we'll go back to you. I don't know if there are any specific areas you're seeing that are harder than others.
I mean, one area which I wish we had exposure to, which we don't, is housing. It's very, very high, and it's a phenomenon where people are leaving cities, and you're seeing with interest rates and mortgage rates where they are, where housing activity has been extremely strong, much stronger than I think anybody would have predicted. So I'd say that's one area where I would say on a positive basis there's been a surprise in terms of the activity in housing. So that would be one. The other interesting question to ask yourself now is emerging markets, and I don't know that this may not be for an audience of emerging markets, but when you think about emerging markets have handled COVID better than the U.S. Full stop. And so one of the areas we're thinking about, we haven't acted, is, and we've been very domestically based, is will they come out of it faster? Will they come out of it quicker? Their government their fiscal debts are not as high as ours. Is this something that we're thinking about in terms of emerging market being the area now you want to gain exposure to that you haven't?
Thank you, Sheldon. Appreciate it. And Dan, I want to thank you as well. This was a great program here. A lot of great information. I'm looking forward to going back and looking at it again. And Chris, will turn it over to you for a wrap up here. And of course, Morgan, thank you as always. And so you answered some really good questions from some very smart people. So thank you.
Terrific. Well, thanks again to our panel. And once again, thanks to everyone for joining us. In addition to this webinar series, we've been holding a variety of timely programs across many areas of interest. Next week on July 28th, we're going to have another session of our Let's Talk series, which features dynamic female leaders all across industries by inviting them to speak about their career journey and their paths to leadership. Next week, as I said, on July 28th is our next session, and that's a conversation with Laura Vanderkam, a notable writer, author, and speaker. So recordings from all of our past webinars, register for upcoming programs, and read up on a number of industry-specific alerts at our website, nixonpeabody.com. You can also subscribe there to any one of our alerts and mailing lists and view past recordings of this series of programs as well. So thanks again to everyone for being with us today, and we'll look forward to speaking with you in a couple of weeks.
Thank you.
Thank you, guys.